Okay, so now we're going to be talking a little bit of part two of the ongoing discussion of the Tax Reform Act, or tax reform law as it is now. So the first one, we just kind of went over the general provisions that affect everybody. And what we're going to talk about right now is the 7 key tax deductions that basically disappeared with the tax reform. So the first one that really could impact people is personal exemptions. The way it used to be is for every person that was in your household that you were claiming on your return, so you, your spouse, your kids, anyone else that you're taking a dependency for, they would get a personal exemption, which was $4,050. So it reduced your income by $4,050 for each person. So if you had 10 kids, plus your wife and you, that's 48,000 plus. That would reduce your income. So that's gone now. And what they did is they basically increased the standard deduction to offset losing the exemptions. So the standard deduction now is basically the old standard deduction plus an allocated amount for exemptions. So you can imagine if you have a lot of exemptions, this could hurt you a little bit, not having that. But the other big thing is they did increase the child tax credit from $1,000 to $2,000, while also increasing the phase out for the child tax credit. So it used to be $75,000 for single, $110,000 for married filing joint. Now it's $200,000 for single, $400K for married. So more people are going to get the child tax credit. So you're losing exemptions, but you're getting more on the child tax credit side. And if you're making more than $400K on the old system, you weren't getting your exemptions anyway. You were phased out. So basically, anybody under $400K is going to get more in the child tax credit. Now, how does this negatively impact you losing the exemptions? Well, it is going to hurt people who maybe are claiming their elderly parents that live in their house. It could be a non-relative. So if you're living with your boyfriend or girlfriend and he or she has kids and you're claiming those children because you're providing more than half their support and they're living in your house, and that does happen quite a bit, believe it or not, well, those exemptions are gone. And then if you do have children that you're claiming that are older than 17, 17 is the phase out for the child tax credit. So at that point, you're losing the exemption. So if you had 6 kids in college, they're all older than 17, well, you're probably going to get hurt a little bit by the new tax law. So let me just give you some examples. Basically, we looked at the 2017 law and then the new HR 1. So for single folks, it's just you. Your standard deduction and exemption before was $10,550 for 2017. 2018 is going to be $12,000. So you actually came out ahead. Same with married couples that don't have any children, $21,050 to $24,000. Now you can also see once you get to 1 kid, 2 kids, 4 kids, you really start to get to the point where the standard deduction exemptions would be substantially higher than the $24,000 standard deduction. Also, if you're going to be having your parents living in your house with you, kids and parents. So you can see as you get more and more dependents, it could hurt you if you don't get access to that child tax credit. So now this looks at total tax savings for married folks with the kids. So we're talking about it impacts people with kids. If you have a lot of children, you might lose out, but not really. It comes back down to that child tax credit was doubled from $1,000 to $2,000. So basically in 2017, if you took the additional amount of standard deductions / exemptions for 2017 compared to the now 2018, your total taxes with the child tax credit tax savings would have been $1,253. So standard deduction and exemption savings was $253. The $1,000 is for the one child for the child tax credit. Excuse me. With the new tax law, it's $2,000 because of the $2,000 child tax credit. So you can see that couple still coming out about $700 to the black. Now married with 2 kids, So under the old law, you'd have $2,000 of child tax credit, and then you have $1,144 from the exemption standard deductions, which is more than what you're getting with the $24,000 deduction now. But you, excuse me, you're still better off because the new law is going to give you $4,000 child tax credit. So the old system with the child tax credit plus the amount of additional standard deduction / exemptions over the new standard deduction amount, you're still coming out almost $900 to the black. You go up to 4 kids, you think maybe losing those exemptions with 4 kids is going to start to hit you, but it's not. So this example, you have $4,000 of child tax credit under the old law, and then you had $2,926 of additional tax savings with the old standard deduction exemption model. But because of the $2,000 child tax credit, you're still coming out ahead. Now, where you start to lose a little bit is if you have, maybe 2 kids and both your parents living with you. So in this case, the loss of the standard or loss of the exemptions for the 2 parents does start to hurt. So now, sorry, you're $900 in the red. And if you were married and you just had your parents and there are no kids, you're going to lose the exemption amounts for that. So that's going to cost you, in this case, almost $1,200. And with all of these examples, I'm assuming that the new tax rate at 22%, the 22% bracket. So that's how I kind of came up with the amounts that you need to have for the standard deduction and exemption amount. So anything that you're losing on standard deduction exemption, I took that amount, multiplied by 22%, and that's how I came up with that. Now, this also changes again. I'm assuming that you're getting the child tax credit. So if your kids are 17 or older, but you're still claiming them, you're losing that child tax credit. So it will be a negative situation for you compared to the old law. Some other key losses, home equity interest deduction. So technically, under the old law, you had to be using your home equity for improvement of your home in order to deduct it. But in the reality, most people, if they had home equity interest, they just took it on their tax return. So there were people that were paying for college, people who were doing vacations, purchasing cars, and doing some home improvements, and they were getting that home interest deduction. Well, that's gone. That's not there anymore. Another one is moving expenses. So a lot of people, we live in an economy where you need to be pretty fluid. It's not the old work at one place for 40 years and retire. So the government used to help you out if you moved more than 50 miles to your new job. They'd help you out with some tax savings. Well, that's gone. And the other bad thing with the moving expenses is they also got rid of employer-paid moving expenses being a non-taxable benefit. So you thought, okay, well, they got rid of the moving expenses on my 1040. I'll just have my employer pay for it. And that's still not going to work. So anything that the employer pays is not going to be considered taxable income. The only caveat with that is the military members, it will be excluded from their pay. So I guess they figure they can't convince military folks to move every 2 years if they're going to be taxed on the cost of the moving expenses. Another one that is going to hit some people, this is a little bit more esoteric. Not a lot of people end up with casualty and theft losses, which is a good thing. So if your house was burglarized, any amount that the insurance company doesn't pay, you could then deduct subject to a 10% threshold of your adjusted gross income. But the thing is, if you had a really big theft, the insurance company is only going to pay you the depreciated value of electronics and computers and all kinds of equipment. So you could have a situation where you would need to write this stuff off. Casualty, we're talking like a hurricane. It could be busted pipes. It could be wind damage. It could be all kinds of things that cause a casualty to your property. Now, the casualty for hurricanes or natural disasters, if it's declared a disaster zone, will still exist. But for everybody else, it's gone. So if you have a big burglary in your house, or your pipes burst in your basement, you come home after a 2-week vacation and everything's destroyed, really at that point you're kind of out of luck as far as the tax return. Some other big ones that are gone now are the miscellaneous deductions. This is going to hit a lot of people. So people who have unreimbursed job expenses, they're no longer going to be able to deduct this. And this does it hits firefighters, it hits cops, mechanics, people who are buying a lot of their own equipment, the guns, the tools, all of that, uniforms. It's going to hit a lot of teachers, because the teacher deduction for $250 of supplies still exists. But a lot of teachers spend more than $250, and they're able to take the rest above the $250 as an itemized deduction. So a lot of these people are going to be hit. People with union dues, people who have a lot of education to keep their qualifications up. I apologize, I'm having some issues here with my cold. But other miscellaneous deductions, tax preparation fees, that's gone. You can't deduct those anymore. So it used to be, once you got past the miscellaneous deductions of a 2% threshold, you had tax prep fees, but also investment planner fees. So, we have an investment planning firm. Our clients deduct their investment planning fees. That's gone. And then, hey, we're well priced. We're great price compared to others, but still it's a cost, and it's nice to be able to deduct it. Other things, trustee fees for IRAs, if you pay those out of your pocket, any kind of interest payments where you're using that to either make money or pay taxes, all of that's gone. So that's going to have a big impact on people. I think that you're going to find some people are going to be hit really hard in future years, because especially people who have union dues plus uniforms, plus they buy their equipment. So they might be looking at a couple $1,000 difference. So that's just the 7 deductions that have basically gone away. I hope that was helpful. If you want some more monthly insights, welcome you to go to our site, Picket Fence Financial, or savingyouFromWallStreet.com. You can get our newsletters there. We'll just keep you abreast of all the different interviews we do. In our office, we have wine and cheese, webinars, seminars. Try to offer a plethora of opportunities for you to get more information. Of course, we also have a Facebook page, Picket Fence Financial, and then on YouTube, you look for Kirk Kinder, and you'll be able to see all my past videos and webinars. And of course, we always finish off with our little disclaimer where the lawyers say hello. So if you have any questions, I'd be happy to discuss with you. Just drop me a line, and I'll do what I can to help you out. Thanks for listening.